Ridham Desai, MD Morgan Stanley, joins us right now to tell us what's likely to move from here, what's the market expecting from the budget, whole host of topics of discussion. And Ridham, I want to first start about GQ. Is it the men's magazine you were referring to, or is it growth and quality?
No, it's growth and quality. It is growth and quality which the market is buying right now. I think the market has been firmly anchored in favor of quality. No prizes for guessing that. I think everybody knows it's fairly obvious. But more recently, the market has been buying growth. And I think you can see it on the ticker. There's a bit of nervousness out there because growth has faltered a bit. So the premium on growth has actually gone up in recent weeks. So the market, I think, is worried that the growth cycle turn is not on hand, and I think doubts are creeping in.
We just heard Indranil's voice exactly the same. Is there also a fear in the market that perhaps it's run up way ahead of what the fundamentals are delivering right now, as we're seeing in the earnings season, and there is some sort of confusion on what's looking overpriced and what's undervalued even now?
Yeah, so the market tends to look forward. So the view that the market was building up and is still, I think, mostly building up. There is that growth is going to turn in the next 12 months. And I think that story is pretty intact, and I'll come to that in a moment. But obviously the recent earnings season has created a bit of doubt. So that's why the premium on growth has expanded and the overall index level has come off a bit. The election results in Delhi may have also played a bit of a role there, but I think it's more to do with the earnings season rather than the election result. And it just creates a little bit of a doubt because stocks had gone up as much as they had. So I think what we are seeing is this preference for growth and quality, and it's clearly asserted in how share prices are being differentiated.
Yeah, therefore GQ and not only Q.
Yeah, GQ. But the point is, Ridham, how does one ascertain that things will improve, say in quarter 4 or maybe even quarter 1? Because I believe a large portion of where the investment cycle turnaround could come in would probably be kick-started by the government, and one doesn't have a handle of when that will happen in the first place.
Yeah, so let me just now delve into the bigger backdrop. So right now we are in a sweet spot for equities. Let's not make any mistake about that.
Okay.
So these 300-400 point corrections will keep coming. They ought to, because the market at 18,900 looked a bit overheated at the end of Jan. It had been the best performing market in the world in that month. So it gave up a bit. The backdrop is as follows. Inflation is moderating and moderating very quickly. Interest rates will fall and will fall more than what the market is expecting right now. Growth, in my view, is improving during the course of this year because government expenditure will come back. Mind you, the government has cut expenditure very, very violently to bring down the fiscal deficit. Right. So that will also change in the course of the next 12 months. There's a huge buffer that has been created because of falling oil prices. So we have a modest pickup in growth and moderating inflation. That's a sweet spot for equities because interest rates are going down and growth is improving. The world at large is supplying deflation, so we really don't need to worry about that, about inflation. We may have to worry about growth from from point to point because growth may not actually do as well in the rest of the world. But I think our own growth signals are getting better. So this is the backdrop. I think this persists maybe for the next 24 months. And therefore, in large part, I think equities trend up rather than down. Okay. With intermittent corrections along the way whenever there is a bit of doubt that creeps in because of one data point. And there will be some erratic data points that will throw up in the system. So that's the backdrop. Sure. In the middle of this, we have other things that are happening. We have policy to deal with, policy meetings of the central bank. Sometimes the RBI will cut, sometimes it will not cut. We have the budget to deal with, which will produce its own set of short-term opportunities. But generally speaking, I think the market trends higher. The one debate that remains on the table is that it's trading at around 20 times trailing earnings. And is that too rich? Yeah. My reckoning is it's not, because corporate profits are really depressed right now. And if corporate profits were to normalize, say even over the next 5 years, profits may CAGR at about 20%. Okay, so you're looking at a meaningful growth in profits over the next 5 years. And if that happened in a shorter time frame because the government surprised us positively on policy, then you're talking about an even bigger CAGR. So the market is not crazy when it's trading at 20 times. But because it's trading at 20 times, whenever there is a weak growth impulse, it will kind of correct like it has recently.
So there's no exuberance yet in the system.
Certainly not. If you're buying growth and quality, you're buying reasonable stuff. When the market starts buying financial leverage, capex and beta, that's when we will know that it's gone crazy. But beta has underperformed.
Yeah.
You look at all the high beta stocks, they have been pummeled since the budget. Since the election results. They're not doing well. They did very well in the run-up to the budget and they've given up all that performance after that. So this is not a typical full-blown bull market. It's still a nascent, hesitant bull market, even though we're up a lot, because we started from a low point.
Ridham, before we delve on certain individual pockets as well, just a word on the budget. You just made a brief reference there. My question is slightly more macro. What happens to the fisc projections? Does the government run the risk and give out a statement which would make people believe that they'll miss the fisc estimates because they want to kickstart the investment cycle and maybe spend a lot more, so be a little more loose in fiscal year 16?
So let me just make 3 or 4 points. So firstly is when the finance minister presented his budget in last July, including us, nobody believed that he'd achieve 4.1. Okay, so our number was 4.5, right? That's where the realistic number is because he inherited 5%. That's what's the real deficit that he inherited. So it seemed very aggressive to go 4.1. Well, the good news is, and hats off to him, he's very close to achieving his target. He'll probably meet his target. So we're at 4.2 right now. We have numbers up to December. And he has raised revenues in the last 1 month, and he's probably got more revenues to raise in the month of March, spectrum as well as divestments. So he will, I think, meet his target. And that will be a phenomenal achievement, given how India's fiscal deficits have slipped versus target persistently over the past few years. Okay, so this is a rare thing for India to experience. Now, the next year. The next year he starts with greater flexibility than any finance minister in my memory. So I don't think in the last 25 years a finance minister has had so much of flexibility that this finance minister has when he starts preparing his budget. And where is that coming from? Well, that's coming largely from global oil prices. And for sure there's risk that oil prices rally, and I think the government will prepare itself for higher oil prices this year rather than lower, which is a sensible thing to do, but the fact is the flexibility remains.
Sure.
They have raised taxes, which amount to an annualized amount of 50 basis points of GDP, and the oil subsidy itself is coming down by an annualized amount of 40 basis points. Plus fertilizer prices are lower. So if you add all this up, he's got 100 basis points of GDP, nearly $18 billion in his back pocket to play around with. So his starting point of deficit is 3.1 already. Now, in the last budget, he said that the roadmap for deficit is 4.1, 3.6, 3. So, therefore, he has already told us that this year's deficit will be 3.6. I don't see reason for him to deviate materially from that. Maybe 10 basis points, here or there, but he will probably stick to 3.6 because that's what he had said, and he has room actually to stick to that. So he doesn't need to actually go out and do 3.8. Even if he does 3.6, he has a 50 basis point stimulus. And this doesn't take into account the measures that will come on account of the expenditure commission, the acceleration in tax revenues that may happen because growth improves, altered divestment targets or any other revenues that he may want to raise. So without all that, he still has enough flexibility in this budget to deliver either tax cuts or spending. Now my own view is that most of the spending will be done from SOEs. Rather than from the government. So the SOEs, the state-owned enterprises will spend money. They've already started doing that. So when we look at the capex signals, they're already turning up, which is why we are more confident on growth this year than what it appears generally speaking when you talk to the street. And I think there will be a bit more stimulus that will come from the budget. I hope that it comes through tax cuts because that will really cheer the corporate sector. And I think it may probably help corporate profits recover and therefore then start a private spending cycle in 2016.
Would it be enough to excite the stock markets though? Because of late we have seen budget becoming more of a non-event.
I agree. Budgets, if you measure them by market reaction of the past 10 years, losing their influence. Gone are the days that they used to produce extreme market reactions like in the 90s. Nowadays they don't.
But
so there's a bit of volatility.
And this time it's on a Saturday, so by one day.
Well, I'm saying, in the days after the budget as well, apart from the day of the budget, and hope market may remain open on Saturday, so you'll still experience that volatility.
There's still hope.
But I think there is 50% chance, or let me not say 50% chance, but there is a case here for this budget to stand out. If it lays down the economic vision of this government in what it wants to do with expenditure and with revenue. See, ultimately the budget is just a statement of the government's expenditure and revenues. And we've been kind of just, just loitering around and not doing anything visionary. The last visionary statement came in '97 when the then finance minister said, let's change India's direct taxes to align with ASEAN levels. But we could not deliver on that because then the Asian financial crisis came, our own growth slowdown came, and a lot of things happened. Oil prices went from $10 to $100. We couldn't deliver. So maybe this is the moment to do it. I don't know. But if I think the market gets a sense that there's a bigger vision, even if it is not to be implemented in the next 12 months, I think it will cheer the budget.
But what about growth, like you're saying? The on-ground reality is very different. And the reason I ask you that is because you have interaction with both FIIs as well as DII clients. Now, the big obvious trade in India was to be long, and part of it was banks. Look at the disastrous earnings. Have your clients now changed their view?
No. So our view has been private sector will outperform SOEs, and that's what's happening on earnings. So in most parts, private banks have handsomely outperformed SOE banks. SOE banks still have a broken balance sheet, they still have an NPL problem, and it's not going away. And what we need is a major recap of SOE banks for them to be able to participate in the next credit cycle. Otherwise, private banks will continue to gain market share. So even where they are and after the performance they've delivered, they'll still continue to outperform SOEs. SOEs keep coming back as quarterly or monthly trade ideas, and then they fade away. So if you look at, if you see, for example, if you measure performance since the budget day, because that was the moment when people thought, okay, now is the moment to buy SOE banks. Most of them are down in absolute terms.
Sure.
Okay, and all the private sector banks are up in absolute terms. Most of the private banks have outperformed the market. So if you take a 6-12 month view, I think that persists. So that selection has to be made. When you say banks, you just don't go and buy everything. I think you buy non-banking finance companies in the private sector, and you buy the private sector retail banks. And so wholesale and retail banks in the private sector are the places where you perch yourself. I think the other, because when we say financials, we also include real estate. You buy mid-cap real estate as well, in my view. So mid-cap real estate, I would add as another angle here. But SOE banks, in large part, I think you avoid.
Nice. And you are one of the most bullish on the street when it comes to banks. I remember the report that came out in January, 40% odd upside. Now, my other question is, how are large brokerages such as yours looking at some of the smaller pockets which are hitherto not talked about too much? Defense, very active with all the deals that you can announce. Railways is probably the first time that even companies are hoping for some miracles coming in from Suresh Prabhu as well. Are foreign institutional clients even bothering to talk about these names right now, or you still wait for a couple of years, let the market caps increase, and then maybe look at them?
See, what is probably ignored most commonly is the fact that foreign institutional investors own 1,200 stocks in India. Okay, so they go pretty deep down the cap curve. Okay, now obviously you cannot have breadth of ownership when you go down the cap curve, but every foreign institutional investor has his favorite. Down the cap curve. And you'll find that, pick up any stock at random, you'll find one FII having some stake in that stock. So there's a lot of faith in the Indian mid-cap and small-cap story. Unfortunately, the liquidity does not allow too many people to participate, but there's still participation. Now, going back to your original question, we are very bullish on industrials. So we are overweight, and we've been adding, and we continue to stay very constructive. If the rate cycle follows our path of expectation, which by the way is we are expecting 150 basis points of cumulative rate cuts this year, that means another 125 to go. And as far as I know, that's a completely out of consensus view. I don't think the street is more than 100. Most people are at 50 to 75. I think you will find industrials will be the best performing sector in 2015. Large cap industrials will deliver stellar performance. Industrials do very well when rates go down because it signals a recovery in capex. So earnings will start getting better. So even though right now the earnings seem patchy at best and really bad in most part, I think we will see that situation change in 3-4 quarters.
Is that also part of the reason why you're bullish on mid-sized realty?
No, mid-sized realty I think is a good structural story to own. I think there is, So I'm actually not so constructive on physical asset demand. I think household India is moving away from physical assets. They're great affinity for them for the last 5 years because of negative real rates to financial assets. You can now see it in equity flows, you can see it in deposit growth, things are improving. But I think there is still a core demand for property to live in, which is your personal residence. And still there are lots of people who are going to buy that for their own consumption, not for investment. So the investment demand goes away. Midcap as real estate companies operate in cities where the demand is largely for personal consumption. So they will see good volume and stable prices. And that I think is good for their business.
Okay. Is there a mismatch, Ridham, to your mind between, is there a glaring mismatch? Something that you believe the market is not seeing, but which will come into being? The rate cuts is something that you believe will happen. But is there anything else out there in sectoral terms where you believe it's looking like a sitting duck right now, but somehow the market is not looking at it as the way you are?
I think technology looks good.
Okay.
I think demand for...
But the market is not underweight that sector.
No, I think if I aggregate institutional position, it's underweight tech.
Okay.
Okay. And I think the demand from the corporate sector in the US and Europe for tech services out of India will remain, I think, quite strong. There is still a need for them to keep their costs under control, but there's also a need for them to invest. And we will probably see that in the performance of tech companies. So I won't be surprised if tech companies, in the subsequent quarters guide their business upwards. Some of them are doing that, others are not. I think there is a generally greater positive environment. The challenge, of course, is the cross-currency headwinds. And the companies that manage those well will report good earnings. So I think that's probably one sector where I would be bullish versus the consensus. I also think that there's been a positive consensus for SOE banks. Now it's waning at this moment because suddenly they've been hit by a bad earnings quarter, but there's still positions out there, and maybe those will unwind in the next 2 months. Unless the government surprises us positively in the budget with the size of the recap. To me, that will be the single biggest thing for the SOE banks more than anything else. And if they announce a very large recap, I don't see them doing it actually. I don't think the budget will have the provisions, but that would be the one that would change our opinion about SOE banks.
Great.
Okay, that's an interesting thought. Ridham, we could go on chatting with you, but we're going to let you go and try and end the show right now. Good chatting with you as always.
Thanks for joining us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.